Hi, everyone. Let me just check one setting really quick. There we go. Well, we got a second leg down from yesterday's large sell-off. Let's take a look at the 60-minute chart. So 60-minute chart, we had a big sell-off yesterday and fairly deep pullback. And today it was a bear flag, and we got a second leg down following the big sell-off. Daily, let me fix one thing really quick. Unfortunately, I just need to make a reminder to delete the 60-minute chart, because for whatever reason, every time I click on it, it is not allowing me to go back to minimize the screen, but I'll delete it and make it later. So here's the daily chart. And by the way, feel free to go ahead and ask questions. I'm going to try and answer them in the first questions, obviously, first. But I'm going to try to hold questions till the end. So we had a big sell-off and we pulled back. This is the daily chart. And you can see fairly deep rally, second leg down. And if you're a bull and you bought anywhere up here, let me change the mouse while I'm thinking about it. I'm turn off the screen for just a second and change the mouse. There we go. So now it should be green. So anyways, we had a big sell-off yesterday, deep pullback, and we got a second leg down. Always in for the daily chart. I don't know. It's hard to say. We're in a trading range, and just like the FOMC, when we went sideways for almost an hour after the report, probability, I think, maybe slightly favors the downside, and we're going to close these gaps. But to me, it's a trading range, and we're probably going to go sideways. That should make it easier to see. Just 1 second here. Okay, there we go. So typically, whenever you have an FOMC day, you typically it's a good idea to just treat it as two separate days. In other words, you have the open, which is obviously bar one over here. And it's typically wise to just around about an hour before the report, just treat it as a new day once the report starts. So for me, most traders should stop trading about an hour into the report. So once you get to, if the report is at 1 o'clock Central Time, somewhere around bar 40 to 42, probably wise to stop trading. Some traders will take trades all through here, but you really need to be able to scalp and you really need to be fairly quick to do it because you can easily get in a bad position a little right before the report. So you're short, you start scaling in, you don't have time to get out, or you buy this close, you scale in, you don't have time to get out, and usually you have to take a loss right before the report is released. So on the open, we have a tight trading range following a fairly tight bull channel. And the one thing I thought on the open was I mentioned it in the pre-market that here I was mentioning on a 60-minute chart, we had a big sell-off and a tight bull channel. And my thought here was this was about 8 o'clock when I was typing the report. My thought was we would try and get a second leg down. However, I thought there would be probably buyers somewhere below. So bears, they sell, they scale in, and they're so disappointed that they look to buy any pullback down here, and it leads to a second leg up. But I also thought the bears would get a second leg down. So whenever you have a sell climax, so we have basically a bear channel, large sell climax bar, and you look to the left and there's prior lows, it'll often pull back and be fairly disappointing because it's a really big bar. It'll pull back and be disappointing and lead to sideways trading before you get a second leg down. We actually had that a few days ago. Which was over here. We had a sell off, big bear bar, and then bad follow through. And it rallied for 5 or 6 bars and then got a small second leg down. But, anyways, let's go back to the open today. So, bar one is, let me do it like this. So, first bar of the day, it is a doji bar, failed breakout of the bar 70 high. Possible double top and a sell off on the open, but bar one is a bull bar. And if this is going to be a trend from the open day, typically you have time to sell. So bar one, probably buyers below scaling and lower. Possible wedge like this, 1, 2, 3. Therefore, even though there might be buyers below, we could easily fall below the 77 low before the bulls come in. So if you're buying here, it's not really ideal. And you have to be really quick to make decisions because for me, if I'm buying here, you really don't want to have a stop down here. If anything, you buy and if it doesn't immediately go up, you're quick to take a small loss. Or I think unfortunately you have to buy more down here, which means your stop is somewhere below it. Bar two, you can see it triggered the buy and went up. So there were buyers below. 3, now we have 3 consecutive bull bars. High one buy, but again, wedge, probably sellers above, but 3 consecutive bull bars. I suspect the bears selling above 2 are selling for a scalp. Someone said about passive buy orders. I'm not sure what you mean by that. Bulls buying for a quick scalp though. And you can see some bears, maybe they sold above 3 for a scalp, but on 4, a lot of those traders are giving up. 4 is a strong enough bull bar. It's probably by the close, trying to break out of this tight trading range and probably going higher. And then 5, we have an even bigger bull bar testing the moving average on the 60-minute chart, which is right here. testing it. Whenever you test the 60-minute moving average, normally price does not stop at the moving average. Kind of like right here on 55 and 57 yesterday. We went several points below it before we pulled back. So we could easily go, if we went 2 or 3 or 4 points below the moving average on a 5-minute chart, we can easily get 10 points or 15 points above the 60-minute chart. 6, an inside bar. The tail on 5 is reason enough for traders to look to take profits. It's also a wedge. Not a great shape, but we have a buy climax up to 53, another buy climax up to 69, another buy climax up to bar 5. And then 7, we have a doji bar. 8, we have a small bear doji. 3 consecutive bear bars might be more sellers above 8 than buyers above 8. And because of that, whenever you have 3 consecutive bear bars and you have a rally from 2 to 7, that it's always in long, but to me, the rally it looks like a leg in a trading range. We had trading range price action here, bull breakout on 4, another bull bar on 5. So there might be more buyers around this area than sellers. And then 8, outside down bar. Is it sell to close at 9 outside down? Is it sell to close on 9? It might be, but to me, you have a leg, 3 doji bars, and then 2 strong bull bars. And here we have a lot of overlapping bars, 6, 7, and 8. And then we have a big bear breakout on 9 with a tail. So it's in essence, we have a trading range for the first 3 bars and then a bull breakout. So it's kind of like a second leg trap. The first leg ending on 3, the second leg ending on bar 5. And then we get a first leg down to bar 8, a pullback, and then a second leg down to bar 9. Well, bar 9 is a surprise bar. It'll probably lead to a second leg down. It could easily have bad follow through. But the traders buying the 9 close are probably buying for scalp. And what that means is they are not interested in buying for swing because they know there's probably sellers above. Maybe if 10, and when I say they're buying the 9 close, on 10, if the next bar, this bar, closed on its high, maybe there would be more buyers above. But to me, when I look at the 9 low and 10, and let me back up. When I look at the 8 low here and 9 went far below it, I know those bulls that bought the 8 low and scaled in lower are going to be disappointed. And if they're disappointed, a lot of those traders are going to look to get out, break even. Because of that, there might be more sellers above 10. So 10 is an inside bar, but it may just be a pullback and lead to a second leg down below 2, 81, or even bar 77. This is still a wedge. 53 yesterday, 69 yesterday, and then a bull breakout to the 5 high. And then 10, testing the doji bar on 8. We had a bull flag. The bulls were expecting a second leg up, and instead we got a bear breakout. That typically will lead to a measured move down from here to here. We're testing the breakout point here, but there might be sellers back at the breakout point, and that's what happened on 12. 12, a little bit of a surprise. It's a second leg down, and 9 was big enough to lead to a second leg down. So we're probably going to fall at least 1 tick below 9, and we'll probably fall below 2 as well. So 12, big enough surprise, probably at least a small second leg down. For the bears, it's a parabolic wedge. 9 for the bulls, parabolic wedge. 7, 9, and then one of these bars over here. If 13 is a really big bull bar, reversing most of this, we may rally back up here. But the problem with the argument that we're going to rally back to the 5 close here is there were buy the close bulls who bought the 5 close. They were disappointed on 6. You know that those bulls that bought the 5 close, disappointed on 6, were able to get out, break even during 7. So there's less of a need for the market to get down here. So bulls buying the 12 close might be more due to bears who are disappointed who sold the 9 low or the 9 close. scaled in lower, getting out break even. That means that the buyers on the 12 close might be buying more for a scalp. And then 13, we have a doji bar. Bulls, some bulls bought the 11 low, bought more on 12. They're looking to get out break even. Others trying to get out break even back at the 11 low. And you can see we went one tick above 13 and sold off. So a little bit of a surprise on 14, second leg down from 12. But to me, the channel down's tight, but it might just be a leg in a trading range. The one thing going for the bears is they have open gaps. So the 7 close, the 8 close, and then the 11 close. There's a gap in here. We have the 9 close and the 13 close. There's a small gap here. 15, another bear bar. Is it sell the close? It might be, but to me, buy climax, pullback, buy climax, pullback, buy climax, probably going to pull back soon. And then you can see we had a strong sell-off down to the 77 low and then a deep pullback. So it's a bear breakout below bear channel that failed. 16 has a big enough tail. Makes me think we're probably going to pull back and go at least. We're probably going to, if we sell off, we'll probably pull back. But the channel down is fairly tight ever since the 11 high. So the upside is probably limited. And you can see the bulls could not even trigger the buy above 16. So the market sold off on 16, rallied on 16, almost to the high of set on 17, and now it's selling off again. 17 is a low one short, but it's at the bottom of a trading range, the 77 low. There might be more buyers below 77, but the bulls that are buying the 17 low are probably buying for a scalp. And a lot of times those bulls buying typically scalp out. So they're not buying for a swing. They're buying anticipating that the market will rally, but then find probably sellers somewhere above. And you'll have some of the bears who sold here scale in higher, betting on a second leg down. 18, bull bar. Tight bull channel or tight bear channel. So there might be more sellers above 18 scaling in higher. And then 19, a doji. You can see it was a bad low one short below 19. 18 was a bad entry bar. And traders even bought the 18 low, betting that this was a strong enough bar. It may get a second leg down after any pullback. 18 was the pullback. And then the bears got a second leg down on 19. 20, another bear bar, but you're getting a lot of tails below bars and a lot of overlapping bars. This could lead to a downside breakout, but when you look at this, it looks more like a leg in a trading range. And because of that, that increases the odds that we're going to go more sideways. 21, a reversal bar, but a micro channel since the 14 high. It's a possible low of the rally, but whenever you have a micro channel in a tight bear channel, even with a lot of overlapping bars, the odds are you're going to break out to the upside, but it's probably going to need a minor reversal first and more sideways trading. So that means there's no rush to buy. 22, a bull bar closing above 21. Good for the bulls. Probably, is it going to go higher? It probably will. But we could easily fall below the 21 low before the bulls come in. And then 23, now we have 3 consecutive bull bars. The bulls with new highs and lows forming higher lows. So we have a high on 22 above 21, a high above 22 after 23. We have a low, higher low, and a higher low. All good for the bulls, increases the odds of buyers below. And then 24 is a bear bar. It went below 23 and found buyers on 25. What about buying the close of 25, betting on higher prices? Some traders will do it, betting on a double bottom in 2 or 3 failed breakout attempts of the 77 low from yesterday. So the bulls buying, they're betting on a breakout of bull flag and a measured move up. And they're betting that these gaps close. 26, it's in the entry bar for the bulls, but failed to close above the moving average. So a little bit sign of a weakness. 26, It's a strong enough bar, probably going to go at least a little higher, even if we fall below the 26 low. And then 27 went below 26, and 28 is the second leg up. It's a possible wedge, 23, 26, and 28, but I suspect there's probably more buyers below 28 than sellers. And the bulls, they want a measured move from this low to this high, which takes you up to here. 29, we have an inside bar. It's probably more of a buy the close bar than a sell the close bar. 28 broke out to the upside and pulled back, closed under 27, which is disappointing, but it's a strong enough upside breakout. This might be the start of a bull breakout above a bear flag, which means 28 is the breakout. It pulled back. 29 is an inside bar, and it's also a pullback, so we could easily break out to the upside up here. And then 30, we have a strong bull close. Enough of a surprise, probably going at least a little bit higher. Targets above, we have the 8 low, the 8 close, the 11 low, anywhere in here. The bulls got trapped buying in this area. And because those bulls got trapped, a lot of them, most bulls would exit. However, some of them would buy and scale in lower, which means they're disappointed. Just like the bulls who bought over here and scaled in lower were disappointed, they will use any rally to exit longs. So I suspect the same thing over here. 31, follow through. It's a weak follow through bar, but it's a follow through, and it's a bar that closed above its midpoint. So probably going at least a little bit higher. 32, a bear bar. It's a possible second leg trap. We have a wedge with 23, 26, and 28. So it's 3 pushes up. 1, 2, 3. Here. And then a bull breakout, second leg. So what do you do with 32? Most traders are probably buying below 32, betting on a second leg up after 30. But trading range day, and in the middle of the range, we could easily test the 29 breakout point before we get the second leg. 33, bear bar. It's the breakout below 32. It's a bad high one above, so some traders might exit. And then 34 is a bear breakout testing the 28 high. Strong enough bear bar at 34, we might get a second leg down, but it's testing an area where bears got trapped. Bears sold the 28 high, they sold the 29 high, scaling in higher. It's testing the break-even price, so there might be more buyers down here than sellers. And then 35, you can see it went one tick below. It actually touched the 30 low and reversed up pretty strong. The bulls that bought the 32 low, scaling in lower, made money. I had to get a sip of water real quick. So 34, enough of a bull bar, or 35, enough bull bar, probably going at least a little bit higher, and probably going to try and get a second leg. So maybe the first leg from 29 to 32, pull back to 35, and a second leg up here. I still think it was reasonable to buy in this area, which means I think this is a magnet. There's bulls who bought the 6 low, the 8 high, the 8 close, anywhere in here, and scaled in lower. And trading range days are typically pretty forgiving, which means the odds are we'll probably test up here and then start to go sideways. Getting late in the day in the report is within about an hour and a half. So a lot of traders will start reducing their position and waiting for the report. We have a bear bar on 37. It's a possible 2 legs up after a wedge. So a wedge, 23, 26, and 28. Bull breakout on 30, second leg up, testing the measured move target. And we have a second leg up after the breakout of the wedge. So probably going to go more sideways in here. There might be more buyers below 37 though, although it's reasonable to get out of longs below 37. There might be some bulls buying below 37, betting that 35 and 36 is strong enough for a second leg. 38, we have a bear bar. It's a doji. It's testing the high of 34. Some bears sold the high of 34, sold more at the high of 32, getting out break even. Probably buyers below. And you can see on the next bar, we tested the high close of 36. You had bulls who bought the 36 close, disappointed after 37 and 38. They scaled in lower and they're getting out back at the 36 close. 40, we have an inside bar, probably going to go a little bit higher, but overlapping bars, tight trading range, not ideal. And then 41 breaking out to the upside, possible wedge, 32, 36, and 41. So now we have two complex wedges here, here, and here, and then 32, 37, and 41. And the first leg of the first wedge is 23, 26, and 28. But we're getting a bull breakout on 42. 42, testing resistance. It's the best looking bull bar in the rally since 21. So there might be more sellers in this area than buyers, but it's a micro channel, 4 consecutive bull bars. So probably more buyers down here than sellers. Doji on 43. So there might be, is it a buy the closed bar, sell the closed bar? Well, it's 2 or 3 legs up, and you have 2 complex tops at an area where traders got trapped. So for me, this is an area where traders take profits. The other problem is we've only got about 45 minutes left until the report, so most traders should wait. And we got a second leg up after the 41, 42 breakout, but testing the highs up here, and then we get another bear bar. So to me, becoming climactic, and it's a tight bull channel, yes, but I would exit shorts. I'd exit longs below 49 for sure, just because you're so close to the report, you're at the high of the range, better to take final profits. What about selling below 49? You can, but like I said, what do? You've only got about 5 bars until the report gets released. So in 25 minutes, and to me, that is just not a lot of time. Then we got 2 legs down, testing the low 44, testing the breakout point in this area right here. And then 53, inside bar, looks like a leg in a trading range, probably going to go sideways into the report. And on the first bar, we got a really big doji bar. Whenever you get a bar like 55, it's a strong rally, then a strong sell-off. It's a trading range bar. You know you're going to get a measured move up or down, but often during the FOMC report, it can take a long time before the breakout happens. So probably buyers below and probably sellers above. Some bulls bought the rally all the way up and they got trapped. So a lot of those bulls, if they didn't, they're disappointed. They bought on the way up, they got trapped, they probably bought more lower. So you know any test up is probably going to fail and lead to some form of a top and more trading range price action. 56, we can see there was more buyers below 55 for a second leg up. There were more buyers below 55 and the market rallied and sold off again. So 2 trading range bars, 55, 56, probably going more sideways. 57, we have a micro double bottom, or from 56, 57. What about buying above 57? It's probably okay. Forcing you to buy in the middle of a tight trading range, though, so really not ideal. But it's probably an okay buy, stop below 57, betting on a test up to here. 58, good bar, but failed to close above 56. Lots of overlapping bars, probably going to go a little bit higher. And then 59, we have another bull bar with a big tail on 59. So it's a warning that something is wrong with the bull case. You can see 58 rallied, sold off into the close. 59 rallied, sold off into the close. 59 closed above 58, so that is good for the bulls. But to me, probably going to go more sideways here. 60 rallied again above 59 and then sold off. What about buying below 60? I would not. It's two legs up. We rallied 55, sold off. We rallied on 60, sold off. We have a breakout point, the high of 57, low of 59 in a trading range. And you know it's very common for breakout points to close in trading ranges. And then we have surprise bear breakout on 61. So we have a double top with 55 and 60. The bears want to break below the neckline, 57, in a measured move down. 61, enough of a surprise, probably going at least a little bit lower. 62, sold off, went below 56, and even below the 20 low down here. It tested it. 30, 75, and 31 even. Okay, so it came within one tick of the low and rallied up sharply. You'll have computer algorithms. Some people will do this, but I think it's more of a computer algorithm trade. They will buy a few ticks from the low. So they may buy, let's say, 3 ticks from the low of this bar and put a stop 1 tick below 21, betting that it'll either be an equal low or it'll form a higher low and a second leg up. And you can see traders that did that did very well, but you know the probability that's low. Bears that sold as the market was going down, they had a windfall profit, so they obviously buying back their position. They bought buying back their position and exiting with a profit. Bulls, they know it's getting climactic on the way down to 62, so they started selling, and the market reversed up sharply. Very big bar on 63. So what about buying above it? Well, it's really bad risk reward. Do you really want to buy above a bar that is over 23 points tall? Probably not. It's the majority of the bar is the size of the entire range. So if you're buying above it, the market would have to go somewhere up here, well above 41.75, just for you to make 1 times your risk if your stop's below 62. That means there's probably more sellers above. And the market's probably going to go more sideways. 63 rallied above the 55 high in selling off. And then 64 an inside bar. So now we have a wedge, 56, 60, 63, double top 55 and 63. The bears want to break below the 62 low and get a measured move down. And then 64 tried to, but rallied. And this is really just a mess. It's basically an expanding triangle here and here, 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 and here. So what do you do here? Traders are trading with limit orders. They're buying below bars, scaling in lower, selling above bars, scaling in lower. You can see bulls that bought the 62 high or 62 close, disappointed on 63. They used the rally on 64 to get out break even. Bears that sold during the 62 sell-off, disappointed by the rally, and they used 65. They used 65 to buy back shorts. Let me just get a sip of water. And then 66 reversal, but probably sellers above 66, sellers above 65. This is clearly a limit order market during the FOMC report. And then a bear bar on 67, and then 68 reversed up and sold off pretty sharply. Probably buyers below, but you know eventually you're going to get a measured move up or down in this range. And then 69 changed the character of this day. We had consecutive big bear bars, and the market closed far above all the bars to the left. 70 Bad follow through. Bulls that bought the 21 low during 69 made money on 70. But with the sell off on 68 and 69, there's probably, and you can see they were disappointed with 70. And a lot of those traders started buying back shorts at the 70 low. Bulls started buying at the 70 low, betting on a scalp. Still probably going to go more sideways, but strong enough breakout. There might be more sellers above, and we could easily go lower. $73, doji, and then 74 an inside bar. And we really sold off in a tight bear channel for the rest of the day, and then we're bouncing here. But whenever you see a breakout like 69.70, the odds are you're going to get a second leg down, and that's what happened. So whenever you have a tight trading range, you know eventually you're going to get a measured move of the range. Didn't quite get that, but we certainly got a measured move of the bars here. And that was really the measured move target. We had a break, the open of 68, close at 69, led basically to the low of the day. Let me make it more accurate. So it came within 2 ticks of this measured move target. For stop orders, reasonable to buy above 5, but I think a lot of traders, maybe they exit on the 8 close. Let me just talk about always in. It's probably a buy above 5. They probably exit on the 8 close or above 8. And really not that easy here. Maybe they sell 14 or 15. And when they see 16, what do? Some will exit, some will stay short, and they'll maybe exit above a bull bar or a point or two above a bear bar, and it doesn't trigger until here. Bears get out on 21, aggressive bulls can buy, betting on a wedge bottom, 16, 17, and 21. But the bulls buying down here, they know it's a tight bear channel, and the odds are it's probably going to have to go more sideways. And bears get out, bulls buy. No reason to get out of the longs here. Certainly no reason to sell. Other bulls probably buy the 29 close. Some will buy 30. Others will wait for a pullback. Maybe they buy above 35, and some get out below 37. It's reasonable, but I don't think you have to. In a situation like 37, if I'm ever long and I don't want to exit below 37, I'll often use a tight stop, maybe the size of the signal bar down. And why the size of the signal bar? Well, the bears, if I'm buying a bear bar closing on its low, and I think the market's in a small pullback trend, typically, if I'm going to be right, the market should not fall 1 times the size of the signal bar range. And maybe you can add 2 ticks, but either way, stop basically somewhere around this area, and it should fail rather quickly. And other traders, when they saw 38 reverse up, they started buying bull bars. I'd certainly get out of longs below 48, and I wouldn't trade after that for sure. Too late in the day, and the report comes out in just a couple of minutes. But bears probably sell if they were going to trade, and you get out somewhere in here. Bulls buy above 57. Bears, no reason to do anything yet. Bears sell 60. Bulls get out, and bears probably exit either on the way down or as it starts to reverse up. Bulls, if they did buy above 62, I don't think it's a good trade. They would probably exit on the retest of 64. Some traders, they look at 62 and 63 and they bought the midpoint. So the market rallied from the 62 low to the 63 high. And as it started to pull back, a lot of traders bought the midpoint. Other traders had limit orders to try and buy the midpoint of this bar, 62. And you can see on 61 or 63, it tested the midpoint, but probably did not fill them. And some bears sell to close 68 just because of the size of the bar. Others wait for the follow through on 69. And really no reason to exit here. And then traders probably just get out above any bar, maybe above 75. Maybe they exit 2 or 3 points or 4 points above 75. And if that's the case, they get out above any bull bar at this point. For limit orders, lots of limit order trading today. Some bears, they bought below 1, some sold above 2, but if they saw 4, they'd probably exit for a small loss. Traders sell above 8, some sell above 10 or a little bit higher, betting on a second leg down. Bears tried to sell the 13 high but failed, and traders buying below everything here. They'll buy the 15 low, or they'll buy maybe the size of 15 down. So instead of 15 low, they buy somewhere a measured move below it, betting that the market will not fall an equal distance. So bulls buy in this area, betting that we're going to go back to the 15 low before the market gets to the measured move of that range. Buyers below 18. What about sellers above 21? I would not. It looks like a leg in a trading range, although the channel is tight. We could easily have a deep pullback. Buyers below 23, buyers below 26, and buyers below 32. Probably sellers above 34 or the 32 high, but I would really rather focus on buying something like the 32 low for the simple fact that we're probably going to get a second leg up after 30. And probably buyers below 43. And then lots of limit orders in here. Buyers below 55, sellers above 56. Even sellers not necessarily selling the 57 high, but they will often sell a measured move of the bar somewhere up here. And then bears, bulls buying any of these lows, scaling in lower. Ideally, same thing on 60. They'll buy a measured move down. We have an obvious target at the 57 high, bear sold, scaled in. So a lot of traders start buying around the 57 high, betting that the market will go sideways. And you can see, you can't see it on this chart, but the market came down and test. During 61, it went down and it tested the 57 high, bounced pretty sharp all the way back to the 60 low. Then it closed on its low. And that's a warning that there was a lot of buying pressure during the bar, which actually lowers the probability of the market going a lot further. And then obviously with the bar going down this much, if you sold the close of 61 and your stop is above 61, you made more than 1 times your risk in less than a minute. And maybe it was longer than a minute, but either way, you made 1 times your risk really quick. So traders would take profits. And then really just buyers below everything, sellers above. Bulls buy the 68 low. They buy more on 70 or 69, but they start exiting here disappointed. And that's what led to the second leg down. Buy the close, sell the close. Buy the close 4. You can sell the close 9. Better to look to sell a pullback though. Sell the close 12, but not really ideal. Some traders, if they're debating selling the close of 12, they will often sell the close of a bar like 13 because it's a bad stop entry buy. Sell the close 15, even sell the close 16, but to me that's a little aggressive. Probably buy the close 30, but probably better if you can scale in lower. Buy the close 36, but possible top of the trading range, better if you can scale in lower. And then buy the close 43, 44. I think that's okay, but you're getting late and high in the range, so not ideal. And then it really wouldn't buy the close, sell the close until maybe 68, better 69. And Let me see here. That's probably it for buy the close, sell the close. You could sell the close 70, 71, betting on a second leg down. But that was probably mostly it. Let me take a look at questions here. Is today's bar a pullback? It was. You can see on the daily chart that the market sold off, had a fairly deep pullback up to here, and then formed a second leg down. So you could call it a pullback. And you can see it on the 60-minute chart. We sold off, rallied, and got a second leg. And then this is strong enough for probably its own second leg down. I do think, though, that today's price action, lots of trading range trading in here, lots of overlap here. So I do expect at some point we're probably going to test back in this area before we go all that much lower. Question, is there a point where you move your stop to break even? I think it really varies on the trade. If I'm trying, in general, if traders are trying to scalp, then they will frequently move their stop to break even. But it just really varies. If the market's moving really fast, I think traders are more prone to move their stops to break even. So if you buy on the way down, let's say you buy the 56 low and then the market's starting to race up, I think a lot of traders just move their stop to break even just in case it sells off sharply again. Or, you buy the 69 close, the market starts to go up, traders will move their stop to break even. But I also think traders are just faster to exit. But as far as, do I use break even stops that frequently? Not really. I think it's better to use price action stops. And, it's kind of like if you bought anywhere over here and then you see 49 at being a bear bar, it's really better just to exit. So I think that is an easier way to handle it. If you sell the close of 14 or 15 and then you get 21, just because it's a bad bar does not mean you should move your stop to break even up here and let it get hit over here, because the odds are it will. Okay, question. I've been studying the Brooks trading course for a year. And for a year now, I still fully understand the micro double bottoms and double tops. How do you distinguish micro double tops and double bottoms from major double tops and double bottoms? Major implies a decent amount of bars. Minor implies not that many bars. So when you think about it, what is major and what is minor? Here, let's take a look at this. Here's a major double bottom. It's not a great double bottom. We have a strong sell-off, pullback, big bear bar. Here's a double top, sell-off, and then a rally. We stalled. We're stalling off here. We have a micro double bottom here. Down and up, down and up. Micro implies minor. So here's a micro wedge. 1, maybe 2, 3. See if I make this bigger. So here's a wedge. 1, 2, 3. Micro wedge. 1, 2, and then 3. But the reality is most micro just means a couple of bars. Here's a micro double bottom, down on 56, up on 56, down on 57, up on 57. Here is a double top. We went up on 55, down on 55, and then we had 2 legs up to 63 and down on 63. So it's a double top with 55 and 63. I would call that a double top because it's about 10 bars. For me, something that's micro, usually the pattern for a double bottom, if it's a micro double bottom or a micro double top, usually is made up of 3 or 4 bars, maybe less than that. Can you explain break even? Break even to me is when a trader, you're getting out of a trade. So, where's an example of a break even trade? If I bought the 8 low here and I see 9, I'm thinking that shouldn't have happened. I bought the 8 low in the hopes that the market would rally on 10. I bought the 8 low hoping that 9 would go straight up, and it didn't. It broke to the downside. Therefore, I may just try and get out of the trade on 10 and 11 over here. That's break even. If I sold, let's say I sold here on 37, I sold below this bar, and then the follow through 38 was terrible. I may just try and get out break even on 39. So if I sold below this bar, 43.75, my entry price is 43.50. I'm disappointed here. And on the next bar, the low is 43 even. So if I was really, really quick, I could get out break even on that trade. Is 27 a higher low? It's a minor higher low. It's not a lot of bars, but it is a higher low. We're channeling up. So that's why I said it was a bull breakout of a bull channel. We have a high 22, pullback 24, high 26, pullback 27, new high 28, and then an inside bar. So it is a channel. Can we trade for speed? I'm not sure what you mean by that question, but in general, you can trade. Someone can trade any time frame. You can trade a 1 minute chart. Most traders cannot. They will not be able to keep up with it, and they will make too many mistakes and really harm themselves. Question: was it okay to sell the breakout below 57? So I'm not sure if you sold. I'm assuming you sold the breakout below 57 during 62. So is it okay to sell the breakout below 57 here during 62? I took the short, ended up exiting as it came back up. I was thinking we might break to the downside and get a measure move down. Yeah, I thought what you did was reasonable. You sold on a stop below 57 and you were betting that we would sell off aggressively, and then the market sold off and then it started to pull back quickly and you got out. And that's reasonable. You have to think about it. If you're going to get a breakout, it shouldn't sell off and then reverse all the way back to the breakout point and really quickly. Here, 61 sold off, reversed back to the breakout point, but it's high in the range. It's also a micro channel of 4 bars. So there were some bulls buying the 60 low or the 59 low and scaling in lower. And those bulls would exit. But as the market's going down and then it starts to reverse up sharply, traders are buying and bulls are buying, betting on higher prices. Reading through questions again. Question: bar 55 is a bear bar that shows the market is going. So bar 55, it's a bear bar that shows market is going to a trading range, or am I wrong? Yeah, it's a big bar, it's overlapping bar. It's probably going to be a trading range. So whenever you have a big bar with tails above and below, It's a trading range bar. Do you ever buy with limit orders using a fast moving average like a 10-minute EMA? There's several traders that do that. I'll often I'll often really just use a smaller time frame if I'm going to do that, and just buy below bars or sell above bars and scaling higher. Yes, someone asked about volume. I do not look at volume. I might for entertainment purposes, but I just look at the chart. Question: do you think bar 29 is a good entry long? Yeah, 29 actually makes a lot of sense for a few reasons. So you have a big sell off, and you look to the left, and there's higher lows. It's a trading range, and you look at the sell off down to 29 to 21, and you think to yourself, it looks good, but it looks weak. It's probably a leg in a trading range. Then you see this really disappointing rally, and you start to look at it and say, yeah, I don't know if this is always in long or always in short. Is this pullback really a pullback that's going to lead to lower prices, or is this a trading range? And if it's a trading range, are we going to get an upside breakout? And 29 is a possible upside start of an upside breakout. I mentioned 28 broke to the upside, pulled back, and 29 is an inside bar. Therefore, there might be more bulls buying above 29 than selling. It's also a bad stop entry short, so it'll increase the probability of traders buying above it. How do you put the moving average? How do you get the 60 EMA moving average on here? I do it the lazy way. And the easiest way is just input 221 into an EMA. Why 221? Because to me, it's close enough. And it at least tells me about where the moving average is. So here, the moving average is about 43. This one, it's about 48, so it's a little off, but normally it's a lot closer than that. Someone asked, they just started scalping. They just started trading a 5-minute chart. Should they scalp or swing trade? Most traders should swing trade, and they should swing trade for this easy example here. And this is going to be my last question I'm going to answer for today. So you can see here are a few examples of the trader's equation. If you're scalping, you're ideally going for a reward that is 1 times your risk, and that leads to a point 2. The problem with point 2 is it's kind of like getting the minimum to pass a college class. It's just enough to pass. It's not necessarily enough to do that well. Here's an example of going for twice your risk and being 40% profitable. You can see both yield the exact same number. If you had to pick which is easier between these right here, would you rather go for, do you think it's easier to be 60% profitable going for 1-to-1? Or do you think it's easier to be 40% profitable going for twice your risk? Sure, you're going to lose more on the 40% profitable, but it's a lot easier to have a positive trader's equation. So most traders, and then the reality is this is kind of marginal. You need to make the return a greater number. So you can make your return or improve your trader's equation 2 ways. You can increase the risk reward, which generally lowers the probability, or you can increase the probability, which generally makes the risk reward worse. So for most traders, they need to try and get to the 70% range and get to 0.4. But look at this. Somebody could just increase their probability. If they're going for 2 to 1, if they could just raise it 7%, really it's 6.5%, then they will be able to get 0.4, which would be much better. So the reality is, should you swing, should you scalp? How confident are you can achieve 70% day after day? And the reality is that is still assuming you can achieve 70% at 1 to 1. If your risk reward is maybe 0.75, so in other words, you're going for 3/4 of your risk, 70% is basically break even. 85%, 80% is now the new goal. So you can see going for half your risk and your loss is your risk is 1, your reward is half, 0.5. 80% is basically the equivalent of 60% 1 to 1. So now, not only do you need to be higher, you need to be above 90%. That is why a lot of traders really try and get at a minimum 1 times the risk, because most traders cannot get 93%. Most traders cannot be 93% profitable and get that. And someone asked, does this include break even trades? This does not include any commission or break even trades. This would assume everything in the world was free and there were no errors ever, which we know is not possible. So these are skewed numbers. So let's think about it in dollars and cents. You know, if you can make, if you're risking $100, your reward's 100, your risk is 100, and let's say you're going for, 2 points. You're risking 2 points to make 2 points. But the reality is that's not true, because your reward, if you're trading, let's say, E-minis, you're really paying $5. So your possible reward, 95, your loss is 105, and your return would be 81. So what that means is you'd make 1.62 points per trade. Let's do it a different way. Let's say you're going for 4, you're risking 4 points. You make, say, risking 8 points, so $400 to make $200. The reward is 195. You got to pay $5 per trade. Your risk is 405. You'll net 3 points per trade on average. The whole point I'm making here is it's really easy. It's very marginal. An easier example would be here. If you're 60% profitable and your risk is 200, your risk is 200, your reward's 200. You lose $205 because you got to pay $5 in commission. If you win, you make $195. Your return per trade is basically $35, which is less than 1 point. If you think about that, this is your return, 70. So you do that in 10 trades, you're going to make maybe 7 points. And your total exposed risk, so what I'm getting at here is it's just not going to work out that well, is the whole point I'm making. And we could spend a lot more time on the math, but unfortunately I do not have time today, but I'll talk more about it. Most traders should focus right here. Don't think about that. Don't think about this. Try and get in this area right here. Work on getting 45% profitable, going for 1 times your risk to get this result. Okay. I hope everyone enjoyed this. As always, feel free to continue to join and ask questions. I will try and do a Q&A session over the weekend when there's time. Okay. Hope everyone enjoyed this. And as always, feel free to go to the Brooks Trading course to find out more information. There's all sorts of forums and things like that. Okay. Hope everyone has a good rest of their day.